Dana, thanks so much. Taking a look now at the New York Stock Exchange Big Board. Investors still seem worried that the Federal Reserve will raise interest rates again due to the recent jobs report.
The stock market took a major dive yesterday afternoon and seemed to stay that way through most of today. Now, the report showed that the market was strong but cooling down.
But what does this all mean for your credit, maybe your mortgage? Here's Alice Barr with more.
Strong but slowing. That's the bottom line from the Labor Department's June jobs report. New numbers out today show the economy added 209,000 jobs in the month of June. That's slightly lower than expected and marks the slowest month of job growth since December 2020. Unemployment ticked down to 3.6%.
The 3.6% is the 17th consecutive month of less than 4% unemployment, which is the longest duration since the 1960s.
Wages are still rising, with average hourly earnings up 4.4% from a year ago. That mixed picture leading most analysts to think the Federal Reserve will raise interest rates again this month to fight stubbornly high inflation.
A 90% chance that the Fed will raise interest rates by 1/4 percentage point.
As the cost of borrowing goes up and consumers feel the pinch from credit cards to mortgage rates, Wall Street investors are wary about the risk for recession.
There is some risk here for investors in the sense that the Fed is not signaling an end to interest rate hikes, so I would expect that we will see more volatility in the stock market.
Treasury Secretary Janet Yellen today focused on the global picture, criticizing China's treatment of American companies, especially in the chips technology industry.
Our economic relationship with China must work for American businesses and American workers.
Secretary Yellen balancing that message with efforts to ease tensions between the world's two largest economies. In Washington, Alice Barr, NBC News.